Hello, and welcome back to our channel. In today's video, we're exploring the intriguing world of finance. We've all heard the saying, comparing apples to oranges. But what about comparing apples to bitcoins? Yes, you heard it right. Today, we're going to delve into the 10 key differences between stocks and cryptocurrencies. Now, before we get started, here's a quick disclaimer. We are not financial advisors. The content in this video is purely for informational and educational purposes. We strongly encourage you to conduct your own research before making any financial decisions. We're going to dissect and discuss the worlds of traditional stocks and the emerging digital currencies. From ownership to regulation, dividends to volatility, and much more. We'll shed light on these two vastly different yet interconnected realms. So let's dive into this fascinating comparison, shall we? First off, we have the concept of ownership. When you buy a stock, you're purchasing a piece of a company. You're buying a share of the company's assets and earnings. You become a shareholder, a partial owner in the company. You may even get voting rights in the company's major decisions. It's like buying a slice of a giant corporate pie. Cryptocurrency, however, operates on a different principle. When you purchase a Bitcoin, an Ether, or any other cryptocurrency, you're not buying a share in a company. You're buying a digital asset, yes, but it doesn't grant you ownership over the network or system it operates within. You don't get voting rights in the Bitcoin network's decisions. You don't own a slice of the crypto pie, so to speak. So while both stocks and cryptocurrencies represent forms of investment, the nature of what you own differs significantly. Ownership, therefore, is the first major difference between stocks and cryptocurrency. Next up, we have regulation. Now, when it comes to stocks, they're tightly controlled by government bodies like the Securities and Exchange Commission in the United States. These entities ensure that the market operates fairly and transparently, protecting investors from fraud and manipulation. On the flip side, cryptocurrencies operate in a decentralized system. This means there's no central authority overseeing transactions or setting rules. It's like the Wild West of finance, where pioneers have the freedom to explore uncharted territories, but also bear the risks that come with it. This lack of regulation can lead to incredible opportunities, but also to significant risks. It's a double-edged sword. It's important to remember that with freedom comes responsibility. So if you're thinking about venturing into the crypto space, be prepared to do your own due diligence. Always remember, the absence of regulation doesn't mean the absence of consequences. So there you have it. The second difference is in the level of regulation. Moving on to dividends. In the traditional stock market, companies often share a portion of their profits with shareholders through dividends. These dividends, typically paid out quarterly, serve as an incentive for investors to hold on to their stocks. It's a way for companies to say thank you for investing in them. On the flip side, cryptocurrencies for the most part don't offer dividends. When you own a Bitcoin or Ethereum, you're not entitled to a share of the profits generated by the network. Instead, the value of your investment is primarily driven by supply and demand dynamics. That said, some crypto projects do offer a form of passive income, such as staking or yield farming, but this is fundamentally different from dividends in the stock market. In a nutshell, if you're looking for a passive income stream from your investments, traditional stocks might be more up your alley. This brings us to the end of our third difference. Now, let's talk about volatility. If you've ever dabbled in the world of cryptocurrency, you've probably heard this term tossed around. In the simplest terms, volatility refers to the rate at which the price of a financial asset increases or decreases. The key difference between stocks and cryptocurrencies lies in the degree of this volatility. Traditional stock markets have their ups and downs, sure, but cryptocurrency markets, they're like roller coasters on rocket fuel. Prices can skyrocket one moment and plummet the next, all within the span of a single day. This high volatility can potentially lead to substantial gains, but it also carries significant risks. Why is this? Well, a lot of it boils down to market maturity. Cryptocurrency markets are still relatively young and highly speculative, leading to much greater price fluctuations. So, if you're someone who prefers a steady ride, stocks might be more your speed. But if you're all about the thrill, cryptocurrencies might just be your ticket. This marks the end of our fourth difference. Next, we'll discuss accessibility. Now, when you're dealing with traditional stocks, you're typically bound by the operating hours of the stock exchanges. That's usually Monday to Friday, 9 to 5, depending on your location. Holidays? Forget about it. But with cryptocurrency, it's a whole different ballgame. Crypto never sleeps. You can trade Bitcoin, Ethereum, Dogecoin, you name it, any time of the day, any day of the week, from anywhere in the world. There are no opening bells or closing whistles here. This round-the-clock availability means that market events can have immediate effects, and traders can respond in real time. It's like having a global all-access pass to the financial world right in your pocket. So whether you're an early bird or a night owl, the crypto market is always awake and ready for business. That's the fifth difference between stocks and crypto. Moving on to value determination. When we talk about stocks, their value is typically tied to the performance of the company they represent. Things like earnings reports, management decisions, and market trends can all impact a stock's price. In essence, the more successful a company is, the more valuable its stocks are likely to become. Now let's compare this to cryptocurrencies. Unlike stocks, the value of a cryptocurrency isn't tied to a company's success or failure. Instead, it's largely driven by supply and demand dynamics. If more people want to buy a particular cryptocurrency than sell it, its price will rise. Conversely, if more people want to sell than buy, the price will fall. Factors such as technological advancements, regulatory news, and even social media influence can stir up demand and affect a cryptocurrency's value. So while both stocks and cryptocurrencies are investment options, the factors determining their value are fundamentally different, and that's the sixth difference. Next, let's discuss tangibility. Tangibility, in the simplest terms, refers to something that can be physically touched or felt. Now, both stocks and cryptocurrencies are intangible assets. You can't exactly hold a Bitcoin or a share of Apple in your hand. But there's a subtle difference in what they represent. When you buy a stock, you're buying a small slice of a company that exists in the real world. You're investing in tangible assets like buildings, products, and people. There's a physicality to what your investment represents, even if the stock itself is intangible. On the flip side, cryptocurrencies are entirely digital. They represent a piece of a digital ledger, a string of code. There's no physical company or asset backing it up. It's a new kind of asset, one that challenges our traditional understanding of what an investment can be. And that was our seventh difference. Moving on to transaction speed. Now here's where things really start to diverge. When you buy or sell a stock, you might think the transaction is instant. You click a button and boom, it's done, right? Well, not quite. Behind the scenes, these transactions can actually take up to 2 business days to settle. That's because stock exchanges operate on what's known as a T+2 settlement period. That's trade date plus 2 days. On the flip side, cryptocurrencies have significantly faster transaction speeds. Thanks to the power of blockchain technology, crypto transactions can be completed in minutes, sometimes even seconds. This is mainly because they operate on a decentralized network, eliminating the need for a middleman, unlike traditional stock exchanges. So if you're looking for speed and efficiency in your transactions, cryptocurrencies have a clear edge over stocks. And that, my friends, is our 8th difference. Transaction speed. That was our 8th difference. Next, we have anonymity, a fascinating aspect of the crypto world that sets it apart from the traditional stock market. Stocks, as you may know, are far from anonymous. Every transaction, every buy or sell is meticulously recorded and traceable. It's part of the regulatory framework that governs the stock market. Now let's compare that to cryptocurrency. The beauty of crypto is that it can be as anonymous as you want it to be. Transactions made with Bitcoin, for example, are recorded on a public ledger known as the blockchain. But, and here's the kicker, they're linked to an alphanumeric address, not the identity of the individual or company making the transaction. So, unless you willingly share your information, your crypto transactions can remain pretty much anonymous. This anonymity is not just a feature, it's a fundamental part of the philosophy behind many cryptocurrencies. And there you have it, folks. That's our 9th difference. Finally, let's discuss supply. This is a key area where stocks and cryptocurrencies differ significantly. When it comes to traditional stocks, the number of shares available in a company can be increased or decreased. This is typically done through actions such as stock splits or share buybacks. Therefore, the supply of stocks is fluid and can change based on the company's strategic decisions. On the other hand, the supply of many cryptocurrencies is fixed. For instance, there will only ever be 21 million Bitcoins in existence. This cap is coded into the Bitcoin protocol, making it unchangeable. This limited supply is one of the main reasons why cryptocurrencies can experience such dramatic price fluctuations. In essence, while the supply of stocks is under the control of the issuing company, the supply of cryptocurrencies is dictated by the underlying protocol. This means that the supply of cryptocurrencies is generally more predictable and transparent than that of stocks. And that wraps up our 10th and final difference. Alright, that was quite a journey. We've ventured through the fascinating world of stocks and cryptocurrencies, exploring 10 key differences. We deliberated how ownership in stocks gives you a piece of a company, while crypto ownership is purely digital. We dived into how regulations differ vastly, with stocks being heavily regulated and crypto being more of a wild west. We examined dividends and how stocks can provide them while crypto doesn't. We also navigated the terrain of volatility, accessibility, and how value is determined in both realms. We touched on the intangible nature of crypto versus the tangible aspect of stocks. We then sprinted through the speedy transactions of crypto compared to the sometimes slower stock transactions. We talked about the anonymous nature of crypto and contrasted it with stocks. Finally, we discussed the fixed supply of many cryptocurrencies versus the potentially infinite supply of stocks. Thanks for watching. Be sure to like, comment, and subscribe. And hit the bell notifications so you'll get updates anytime we new video.